On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Okay, where to begin? Geez, it was a busy week last week, and there's plenty coming up this week as well. So, my advice would be to make sure your coffee is full if you're not driving and or running or walking or whatever. And if you've got the ability to fill up the cup of coffee, cup of tea, please do so. I will try and whiz through this as quickly as I can because we'll be here all day if I dwell too much on some of these things. So straight into it. Share markets had another good week. The S&P 500 up another 1%. More evidence that inflation is coming under control and more solid earnings releases. So the market was strong. And if we think back to those lows of last October 2022, the US share market has rallied 28.1% from those levels. So it's only just 4.5% below its all-time high, which came in the second half of 2021. So, been a very good rebound. Actually, might have been early 2022 that peak, but there or thereabouts. We're not far away from it. The tech sector has played a big role in that recovery. One prominent index, the NYSE FANG Plus index, which basically represents all the big tech stocks, it's up 80% this year, 80, and it's actually hit new record highs over the last few weeks. So trading very close to those record highs. And its worst point last year, it had fallen almost 50% from its peak. So that has been a big driver of the strong returns we've seen. But other markets were good too. Europe was up 1.2%. The FTSE 100 a little bit higher, about 0.4% higher. Emerging markets up 2.8%. The Aussie market up 1.2%. We were flat, our market, but we're still holding our own this year, even though we have lagged some of those international markets. And across the board, it was a pretty good week. Interest rates, US 2-year Treasury yields up just marginally, 10-year yields up from 3.8 to just shy of 4. Our interest rates were up a little bit too in this part of the world, ever so slightly though. So not a huge amount of action on the interest rate front. But if we think back to some of the key releases, and I'll try and go through them all reasonably swiftly. We had the flash PMIs early last week. So these are activity indicators, and they pointed to a further slowing of activity during July. This was one of the first releases we got for the month of July, and there was a clear trend of things slowing down. Some regions even slipping into contraction. So Australia and Europe fell below the 50 break-even level, which means those economies, at least using this measure at least, are contracting. So they hit the lowest in 7 and 8 months respectively. The UK was pretty stagnant. Japan was actually okay. Japanese economy has been reasonably solid this year. And the US was strong too. So the composite PMI, which encompasses the manufacturing sector and the services sector, always talking about composite PMIs because you've got to put all those things together. The US composite PMI did come back a little bit. So it's sitting at the lowest since February, but it's still comfortably in expansionary territory, sitting at 52.0. So 50 is your break-even level. You have still got that divergence between the manufacturing sector and the services sector. And in Europe, that was particularly evident. You had the manufacturing PMI falling to 42.7, which is a more than 3-year low. And in contrast, the services PMI 51.1. The inflation indicators in all of those surveys a little bit mixed, probably more bad than good, to be honest. In Europe, service sector costs still running well above the long-term average, but the rate of increase is slowing. Sitting at the lowest level since May 2021, but still very high. In the US, where we have seen inflation come down very sharply, the headline CPI is down to 3.0% now, well down from 9 a year ago, the lowest in more than 2 years. But looking at these PMIs, it looks like that stickiness of price pressures is still going to be quite a concern. So the survey index in that PMI survey, the survey index of selling prices has been a very good leading indicator of the recent falls we've seen in the US CPI, and it's now sending a signal that the declines from here will be a bit tougher to get. So, long story short, it's been much easier to get inflation from where it was down to sort of that 3% level, but that sort of last mile of getting it from 3 to 2 could be a bit more difficult. On the central bank front, we had 3 central bank meetings. We had the Fed, that was the one everyone was anticipating just because they're so big and influential. They hiked their interest rate, their main interest rate, by 0.25%. That was widely expected. It takes their Fed funds rate to 5.5%. That's the same as ours here in New Zealand. And it's the highest since 2001. They didn't give much away in terms of what they would do next. There was very little for people to latch onto. So they really are hedging their bets and playing their cards quite close to their chest. And I think you would do that because they are in a situation where they've done most of the work, if not all, that they need to do in terms of hiking interest rates. And from here, they'll just watch the data. They'll just see how things play out. So markets are still a little bit divided about what we'll see from the Fed next. They themselves have guided to one additional increase from here. That would take the Fed funds rate to 5.75, although financial markets aren't convinced. They're only pricing that in to the tune of about 40%. So, there's a 60% likelihood in the eyes of financial markets that they're at the top and they don't do any more from here. We had the European Central Bank, and again, they were expected to hike interest rates by 0.25%, just like the Fed, and they did do that. So this one was widely in line with expectations too. That sees their key interest rate at 3.75%. That's the highest since 2001. They're still playing a bit of catch up. As I've said before, it was only July last year, so only just over a year ago. Early July it was, they still had a negative interest rate. So, they've only come back into positive territory, 12 months ago, whereas we started raising interest rates in August 2021. It's nearly 2 years ago, and the Fed was somewhere in between. So Europe's still got a little bit of catch up to do, and inflation's still quite high. It slowed from where it was. It was 10.6% in October last year. Now it's 5.5%. But 5.5 is still higher than you're seeing in a lot of places, at least internationally. That's not as high as what we're seeing here in New Zealand, but it's still high when you haven't sort of raised interest rates as much as you're planning to. So I think there is a good chance you might see one further hike from the ECB later in the year. But it was actually the Bank of Japan that stole the show. This was the one that was expected to be sort of a little bit dull, and everyone had their eye on the Fed and then the ECB. But on Friday, the Bank of Japan stole the headlines. And what happened is that they announced that they will move a bit closer towards finishing up with that yield curve control program, which they've had in place for several years now, since 2016. I think that came in, and that's been a real anchor for interest rates around the world, because what they did back in 2016 was they said that they would buy 10-year Japanese government bonds, JGBs, that they'd buy as many of those as they need to at a particular yield, which was, in recent times it's been about 0.5%, which is essentially the price. They're basically saying we will buy these for 0.5%. So, that kind of caps the price, because it's not going to go above that when they're buying an infinite amount at that level. So that was That was something they did to sort of control the shape of the interest rate curve. They had their cash rate, their policy rate, their short-term rate at pretty much zero, and they're trying to sort of control that 10-year rate by that sort of buying, which kind of anchors rates at that level, and then sort of beyond that, 20 years, 30 years interest rates, government bonds. They can sort of just naturally go to where they'll go, but they were controlling all of that sort of part of the yield curve from very short term out to sort of 10 years. And the goal there was to keep interest rates anchored and low, to stimulate lending, to stimulate growth, and to actually create a bit of inflation, because you cast your mind back over recent years and they've had much lower inflation than the rest of the world. It's increased more recently, which is part of the reason that they're winding this back. So on Friday, contrary to what the vast bulk of people were expecting, they left their short-term interest rate unchanged. That bit was expected, but they announced a switch to a more flexible approach when it comes to that bond buying. So they've now basically said they will offer to buy bonds at up to 1%, rather than 0.5%. So they're basically saying we will tolerate JGBs, 10-year Japanese government bonds, trading at a yield of 1%. Before we didn't want them going higher than 0.5%, so we'll just buy as many as we need to keep them there. But now sort of our tolerance is a little bit looser, so we don't mind if the 10-year yield goes up to 1%. So that was a bit of a surprise. People didn't see that coming. So what it means is that the Bank of Japan is going to allow yields in that part of the interest rate curve to rise, and you're already seeing a bit of a ripple effect across financial markets, but I think you'll see more. It basically makes Japanese bonds more attractive to global investors who can put their money anywhere. 1% still pretty mediocre, but it's double 0.5%, isn't it? So in a relative sense, Japanese bonds still become much more attractive than they were before, and more attractive compared with other bonds around the world, which haven't seen that same increase compared to what they were at, before last week. So I think you could see money move from some other bond markets into Japan. That would add headwinds to bond markets elsewhere. If you get sort of money move out of US bonds into Japanese bonds or whatever. And it could also put a bit of upward pressure on the Japanese yen. So could be a bit of a handbrake for the equity market. Higher interest rates, more people looking at bonds rather than equities, higher currency, which could sort of make some of those Japanese exporters less competitive. But if you're sitting here in New Zealand and you've got an exposure to the Japanese equity market through whichever ETF or fund or stocks your advisor sort of has put you into, you'll win on the one hand, lose on the other potentially, because even if you do see the equity market maybe a little bit softer than it would have otherwise been, you will win in terms of the currency pushing a little bit higher, maybe, if things play out that way. But that's something we'll be watching. To be honest, that was probably the biggest news of the week. Although the US inflation figures we got on Friday evening were also very important. So these came through to us on Saturday, and this was the Personal Consumption Expenditures Index, the PCE index, which is the Fed's preferred inflation measure. That's why it's important. And as we saw with the regular CPI, it slowed. So the headline PCE increased at an annual rate of 3% in June. That's down from 3.8 the previous month, in line with forecasts, but the lowest since March 2021. So that's good news. The core PCE, like the regular CPI, a little bit more stubborn. It was a bit higher. It was 4.1%. In terms of the year in terms of the annual rate of change, 4.1%. So that's still better than the previous month. It was 4.6 in May, but it was slightly below forecast because I think people were expecting it to come in at 4.2. So that was good news, and that was the lowest we'd seen in about 20 months, so not quite 2 years. So it was an eventful week, and that inflation report was relevant to US equities, and apart from that, it was probably that Bank of Japan announcement that was important for lots of other asset classes, bonds, currencies, everywhere. Looking ahead, there is plenty to keep tabs on. Locally, the big release will be the labour force report. So this will be the June quarter labour force report, due at 10:45 a.m. on Wednesday, and this will be interesting because after we had that stronger inflation report, I think wage growth and the labour market takes on a lot more importance in terms of what the Reserve Bank's looking for and what they may or may not do with the official cash rate. So if there's anything that's going to sort of push them into another OCR hike, it would probably be, having already seen inflation that's running a bit hotter than they would like in a domestic sense. But anything that would sort of push them into definitely making another move would probably be super strong employment data. Wage growth that's still coming through thick and fast, very tight labour market, no signs of an easing. So I think this is quite an important one. And in terms of what is expected, the unemployment rate for the previous quarter, so March 2023, sitting at 3.4%, and wage growth had still been running pretty hot. Average hourly earnings increased 8.2% in that quarter annually. So Reserve Bank forecasts see both of those things sort of coming off the boil a little bit. So in terms of the unemployment rate, the RBNZ sees it just ticking a little bit higher to 3.5, which is still very, very low, but it'll be a little bit more than what it was. And they see growth in average hourly earnings slowing to 7.6%, which is still very high, but again, a step in the right direction. And economists' forecasts aren't too far out of line with that. So we'll be watching that on Wednesday morning. Also on Wednesday morning, we'll get a dairy price update, and obviously the dairy sector has just been doing it tough lately. Prices have been coming down. 4 out of the last 5 auctions have seen declines. Prices are at the lowest level since November 2020. Down almost 10% this year, well down on those 15-year highs we saw from March last year. Fonterra's got a midpoint for this season of about $8 in terms of the milk payout, but you're starting to see some of the economists revise their estimates down. So I know ANZ's come down 50 cents to 7.75. And Westpac as well has come down. They were quite high. They were in the eights, the high eights actually, but they've come down to $7.80. So people are sort of in those, mid to high sevens now in terms of a milk payout, which is okay relative to history, but because costs are up, labour costs and so forth, interest bills are higher. $7 or $8 isn't what it used to be. And China is playing a big role in the weakness that you're seeing as well. I think those two banks I mentioned both talked about global demand for dairy products being a little bit softer, particularly coming out of China, and that's something that Fonterra has talked about as well. So that's on Wednesday morning as well. Earlier in the week, Monday afternoon, we will get some business confidence figures out of ANZ, the ANZ Business Outlook Survey. That's due Monday at 1 o'clock. This will be important as well. Sentiment obviously really important. I suspect firms are still a bit cautious. You've got the election coming up and so forth, but you did see a nice lift in confidence a month ago. You saw the headline confidence numbers rise to the highest since November 2021. Own activity pushed back into positive territory for the first time in more than a year. So both those things are below long-term averages, but they've picked themselves up from being really, really out for the count. So that's important. I think some of the inflation indicators and the feedback we get from firms about where wages are headed will be quite important in this survey, because they will tell us sort of where wages are tracking in the future. We'll get that labour market report that I just mentioned a few minutes ago, and that's kind of backward looking. It's telling us what's happened in the June quarter, so April, May, June. But we really want to know what's happening here and now and what's coming up over the next 6 months, 12 months. So sometimes those business surveys and so forth give you a better feel for what's coming rather than what's in the recent past. Although it's all important, the recent past is important because you can sort of extrapolate out the direction of travel. So you look at all things all together. Central banks, we've got a couple to keep an eye on. The RBA across the Tasman, they will announce their latest interest rate decision Tuesday afternoon, 4:30. Their cash rate sitting at 4.1%, highest since 2012, getting towards the peak of that cycle. It got to 4.75 in 2011. Markets are most people are expecting no change this week. Pricing, financial market pricing implies an almost 80% chance of no change. So 20 odd percent chance of a hike. So we'll just have to wait and see what has changed for expectations with the Reserve Bank of Australia, because it wasn't so long ago people were expecting another 2 hikes from here, and now they're only sort of in the 1 hike camp, and not this week, but later in the year. So expectations have come back, and that's because we've seen inflation slowing more than expected. Last week we had the CPI figures out of Aussie, and we saw a pleasing decline. So the headline annual inflation rate came down to 6%. Forecasts were for 6.2. That's the lowest in 5 quarters. And the trimmed mean CPI, which is what the Reserve Bank of Australia is more focused on, that also came down. So that came down to an annual rate of 5.9. And that was also a little below expectations, and that's the lowest in 12 months as well. So inflation very recently in Australia has been behaving itself more than it has, in the period before that. So that has just seen people maybe just soften some of those RBA rate hike expectations. The UK, they're meeting on Thursday, and I think they will increase interest rates. Actually, I'm very, very confident they will. They have for the last 13 meetings in a row, and they've taken their policy rate to 5%. That's the highest since 2008. And this week, it's more a case of how much do they move by? Do they go 0.25% or do they go 0.5%? Probably 0.25% is more likely. But you never know. The UK is still battling very high inflation, and even though, like Australia, like the US, recent inflation figures have been a little softer than expected, it's still tracking at an annual rate of 7.9%. So they are still battling an inflation issue, and they want to get it under control. So I suspect you'll get a hike out of the Bank of England on Thursday. If I had to guess, I'd say that the RBA across the Tasman will probably just hold fire. Economic data, there's plenty coming out. We've got the ISM indices in the US, Institute of Supply Management. So you get the manufacturing one on Tuesday, you get the services one on Thursday. These will be important because the Fed is in sort of watch and wait mode. They didn't do anything last week, and they played their cards very close to their chest. That's because they could sort of go either way. They could be done from here if the data tells them that they don't need to do anymore, or they could sort of hike again at some point. Actually, sorry, what am I saying? They did hike last week, didn't they? But they didn't tell us any more about what they would do beyond that. So the data becomes very important for the Fed, and the ISM data will be something they'll be watching closely, as will the jobs report, which comes out in the US late in the week. That's out on Friday. So we'll be watching sort of how that tracks as well. And lastly, on the economic front, we've got some PMIs out of China. So these will cover the same period as those ones I talked about, just 10 minutes ago for the US and Europe and so forth. We just get them a week later out of China. So there'll be a swag of them that will come out on Monday afternoon at 1:30 p.m. And then later in the week, you'll get, a few other bits and pieces. China has obviously been struggling a little bit lately. You've got softness in the manufacturing sector. Services sector's okay, but manufacturing's not in a great spot. Property sector's not in a great spot. And, retail sales, when we last got some monthly retail sales figures, were quite disappointing too. So China is not performing as strongly as we would like. There was an announcement last week about some additional government stimulus, but we'd rather them be in a position where the government isn't needing to stimulate. We'd rather them be sort of recovering and rebounding the way that we were hoping the Chinese economy would when it reopened at the beginning of this year. And the earnings season will be in focus as well. So we're about halfway through the US earnings season. And it's been pretty good, pretty good. Of the companies that have announced results, about 80% have beaten estimates, and on average, they've beaten estimates by 5.9%. So it's been a good start to the earnings season. And last week there was a bunch of other companies that came out with good results, and it's not just the tech stocks or the exciting growth stocks. It was some of the stocks that have been a bit more under the radar, or maybe had a more sort of checkered sort of run. So Intel, responded very well to its result. Boeing, McDonald's. McDonald's is always a very consistent performer, but all of those stocks had results that the market liked, and there'll be plenty more coming. Another 160, 170 S&P 500 companies scheduled to report results this week. So lots of big names. We've got Amazon and Apple both reporting on Thursday. Lots of other companies to watch too. Republic Services on Monday. On Tuesday, Caterpillar, Diageo, Ecolab, Starbucks. Wednesday, you've got CVS Health, Kraft Heinz, PayPal. Thursday, in addition to Amazon and Apple, Adidas, FMC, Nintendo. So, lots going on. Not so much in this part of the world. New Zealand and Australia, there's a sprinkling of companies that announce results, but it's not really a proper reporting season. The proper reporting season starts in August, so got a week or two to wait. It's usually sort of second week of August. So I think across the Tasman, ResMed, the healthcare company, might have a quarterly result late in the week, and I think Hardy's has got an annual meeting, but that's pretty much it. We'll have to wait for the international reporting season to wrap up, and then the baton will be passed to this part of the world, and you'll get a flurry of results sort of through the second, third, fourth week of August across New Zealand and Australia. So look, that's all I had to say. But geez, it's busy, isn't it? There was a lot going on last week, and there's still plenty going on this week. Markets are in good spirits. Investors are feeling more confident about the outlook, with these good solid earnings coming through, and more evidence that inflation is slowly but surely coming under control. So we will watch and monitor all of those other things that are coming out in the days ahead, and talk about them this time next week. Thanks for listening.
For more insights, visit craigsip.com.